Ever get the feeling that you're like looking at the stock market through this, um, in like a foggy window?
Yeah.
Like everybody else has this like crystal clear view, but you're just kind of like squinting through the fog trying to make sense of it all.
It can feel that way for sure.
And I mean, what if I told you there was this book? It was written like almost 100 years ago,
Hmm.
but it can totally like wipe that fog away.
Interesting.
It's like gives you these like timeless principles to understand investing and make like actually smart decisions.
Well, I'm intrigued. What's this book you're talking about?
All right, so welcome to Beyond the Pages. Like always, we believe the right book can literally change everything.
That's right.
And so today, we're diving deep into a book that a lot of people call the investment Bible, The Intelligent Investor by Benjamin Graham.
Oh, a classic. I'm familiar with that one.
Yeah, this isn't just like some dusty old book from the past, you know.
Mhm.
It's like this book has shaped how tons of successful investors think about the market,
Mm.
like for generations.
It's incredibly influential, for sure.
Yeah. And I mean, like Warren Buffett himself called it by far the best book on investing. And that's like,
If Warren Buffett says it,
yeah, like you can't really get a better recommendation than that.
you really can't.
So to really get why this book is so important, it helps to know a little bit about Benjamin Graham himself.
Hmm.
Like he didn't come from like a rich Wall Street family or anything. He started as a clerk in this like bond trading firm.
Humble beginnings.
Yeah, totally. He worked his way up like really hard to become an analyst and then a partner. And finally, he ended up running his own super successful investment partnership.
A real self-made success story.
Yeah, totally. And you know what? I remember reading this story about him. It was early in his career. He invested in this new tire company. It was called Savold Tire.
Okay. What happened?
Well, this was back in like 1919, and the stock price just exploded. Like on the first day of trading, it went up by like 250%.
Wow.
Yeah, he probably felt like he'd hit the jackpot.
I bet a 250% gain right out of the gate. That's incredible.
Yeah, but it didn't last. It turned out that the company like wasn't built on solid ground,
Right.
and really quickly the stock just became worthless.
Oof. That must have been a tough lesson to learn.
Oh, totally.
Yeah.
I mean, it was really painful, but it taught him a lot about the risks of just speculating without really understanding what you're investing in.
A valuable lesson, even if it came at a cost.
Yeah, and you know, later on he was this like master at finding hidden value in companies. Like there was this one company, Northern Pipeline Co., and the stock was trading for like $65 a share.
Okay.
But Graham, he's like really dug deep into these like obscure financial reports, and he found out that they had at least $80 per share in like really high quality bonds.
So the stock was trading for less than the value of its bond holdings alone.
Yeah, like it was a no-brainer. So he bought a bunch of the stock. He started advocating for them to pay out a bigger dividend, and like years later, he made a huge profit.
A classic Graham value play. That's
Yep.
fascinating.
Yeah. So we know this book is like really important. It's got a great track record. But today, what we really want to do for you listening is like uncover the essential wisdom in Graham's work.
The real meat of it.
Exactly. And one thing we want to make clear right away is that being an intelligent investor, the way Graham meant it, isn't about like having this super high IQ.
Right. It's not about being a genius.
Yeah, Graham actually said it's more about your temperament, like your emotional discipline.
That's interesting. So it's more about how you handle your emotions than how smart you are.
Exactly. It's about like staying patient, having a disciplined approach, always being ready to learn new things, keeping your emotions in check, and like thinking for yourself. That's the kind of intelligence we're talking about in this deep dive.
Gotcha. So it's less about raw brain power and more about having the right mindset and emotional discipline.
Totally. So let's jump into the book. One of the first things Graham talks about is the difference between investing and speculation.
Right. That seems like a pretty fundamental concept to get straight.
It's like the starting point for anyone who wants to understand the market. So Graham says that investing is about two main things. One is the safety of your initial investment, your principal, and the other is the expectation of getting a decent return over time.
Okay, that makes sense. So you're putting your money in something that's relatively safe and you expect it to grow steadily over the long term?
Exactly. Now, speculation, on the other hand, is way riskier. And it's all about trying to make a quick buck from the way prices move up and down in the short term.
Got it. So speculation is more about timing the market and hoping to catch the right wave, whereas investing is about finding solid companies and holding them for the long haul.
Yeah, that's a good way to put it. And a lot of times people who are speculating, they don't even really understand the underlying value of what they're putting their money into.
So they're basically gambling, hoping to get lucky.
Yeah, pretty much. And Graham actually gives this really clear example. He talks about someone who's new to the market and decides to sell a stock short. So that means they're betting that the price of the stock will go down.
Right.
But they're doing this purely based on like a gut feeling or some emotional reaction they're having, not based on any kind of real analysis.
I see. So they're letting their emotions guide their decisions, which is rarely a good idea in investing.
Exactly. And Graham says that this kind of behavior, it's a symptom of what he calls enthusiasm or excessive optimism in the market. He saw this happen a lot on Wall Street. Like people get caught up in these market frenzies, whether it's about the auto industry way back when or, like the dot-com bubble more recently.
Right.
And he's warning that like enthusiasm is great in a lot of areas of life, but in investing, it almost always ends in disappointment.
It's like getting swept up in the excitement of the moment without thinking about the long-term consequences.
Yeah, exactly. It reminds me of that story about Sir Isaac Newton, like the super brilliant scientist who lost a fortune to the South Sea bubble.
Oh, yeah, the guy who discovered gravity.
Yeah, he got caught up in the hype too. Graham would have totally understood that. So just to recap, investing is about the safety of your money and a reasonable return. Speculation is about taking bigger risks and trying to time the market.
Okay, got it. So investing is the long game. Speculation is more like a quick gamble.
Exactly. Now, there's this phrase you always hear about when people talk about Graham. It's margin of safety.
Oh, yeah, I've heard that term before, but I'm not entirely sure what it means.
Yeah, so what is that concept all about?
So the margin of safety is like the cornerstone of Graham's whole investment philosophy. It's like having an airbag in your car for your investments. It's there to protect you if things go wrong. When he talks about stocks, he often describes it as the difference between the earnings yield of a stock. That's like the company's annual earnings per share divided by the current stock price and the interest rate you could get on like really safe bonds.
Okay, so like if a stock's earnings yield is, say, 9% and you could get like 4% on a bond, that 5% difference is your margin of safety.
Exactly. That extra 5% from earnings gives you a cushion in case something bad happens. Like maybe the company has some bad news or the economy takes a hit, or maybe you just didn't analyze the company as well as you thought you did.
Right, so it's like a buffer zone.
Exactly. And it basically means not paying too much for an asset. And actually, in the commentary, it talks about how Graham noticed back in 1972 that this margin of safety had gotten a lot smaller or even disappeared for a lot of stocks compared to what bonds were paying at the time.
Yeah, because if you pay way too much for a stock, even if it's a great company, there's just less room for things to go wrong.
Right. You're basically betting that everything will go perfectly.
Totally. And Graham was really against getting caught up in all the hype about growth and forgetting about the price you're paying.
Mhm.
He used to point to industries that had been growing like crazy for years, like the airline industry.
Okay.
And even though those companies were expanding like crazy, the overall profits for investors were actually pretty bad.
So even though the companies were growing, the investors weren't necessarily making money.
Yeah. The lesson here is not to avoid growth companies altogether, but to always ask yourself, how much am I paying for this growth?
Mhm.
And make sure you're getting a good margin of safety.
So it's not about avoiding growth, it's about paying a reasonable price for it.
Exactly. Now, this kind of leads us to another one of Graham's big ideas. The difference between a defensive investor and an enterprising investor.
Okay, so this is getting into the different ways people approach investing.
Yeah. Graham understood that not everyone has the same amount of time or energy or even interest in managing their investments.
Makes sense.
Yeah.
Some people want to be really hands-on and others just want to set it and forget it.
Exactly. So the defensive investor, they're all about keeping things simple. They want to avoid big losses, and they're looking for steady returns over the long term without having to worry about it too much.
So low stress, steady growth. What does a defensive investor's portfolio actually look like?
Well, Graham said they should divide their money between high-quality bonds and a bunch of different leading common stocks. He even said you should never have less than 25% or more than 75% in either category. Like a 50-50 split is a good place to start.
Okay, and then just rebalance as needed.
Yeah. And the idea is to rebalance it every so often based on how the market is doing overall. Like if stocks are looking expensive, you shift more into bonds. And if stocks are looking cheap, you shift more into stocks.
So it's kind of like setting your portfolio on autopilot with a few adjustments here and there.
Yep, pretty much. The key for defensive investors is to stick to high-quality investments and spread their money around so they're not putting all their eggs in one basket.
Diversification is key.
Exactly. Now, on the other side, we have the enterprising investor.
So this is the investor who's willing to roll up their sleeves and do some serious research.
Totally. The enterprising investor, they're willing to put in more time and effort. They want to learn more about investing so they can make better decisions and hopefully get bigger returns than the defensive investor.
So they're more actively involved in managing their investments. What kind of strategies would an enterprising investor use?
Well, they might try to buy stocks when the market is down. They might try to pick out growth stocks, but they're always careful not to overpay. They might look for what Graham called bargain issues, like stocks that are trading for less than what the company is actually worth.
Okay.
And they might even look into special situations like companies that are being liquidated or reorganized.
So they're digging deeper and looking for opportunities that the average investor might miss.
Yeah, exactly. But even though Graham was all about finding undervalued companies, he was also really cautious about just chasing after companies that everyone was saying were going to grow really fast.
Because hype doesn't always equal profits.
Right. He would say that just because an industry or a company has great potential, it doesn't mean investors will make a lot of money. He gave the example of this fund called the Missiles, Rockets, Jets, and Automation Fund.
Oh, wow. That sounds like it was from a time when everyone was super excited about space exploration and technology.
Yeah, exactly. And even though it had a cool name, it was a terrible investment for a lot of people.
So even when there's a lot of excitement and potential, investors still need to be careful.
Always. The lesson is that by the time everyone knows about a company's growth potential, the price of the stock has probably already gone up to reflect that. So there's less room for you to make money and less margin of safety.
Makes sense. So how do these different types of investors handle the ups and downs of the market? I mean, the market is volatile. It goes up, it goes down. It can be pretty scary for a lot of people.
Oh, yeah, for sure. So Graham had this great way of explaining this. He called it Mr. Market.
Mr. Market.
Yeah. He basically said that you should imagine the stock market as this, like, sometimes irrational business partner.
Mhm.
His name is Mr. Market. And every day he comes to you and offers to buy or sell shares of your stocks.
Okay.
And sometimes he's like super optimistic and he'll offer you a really high price for your shares.
Like he's in a great mood.
Exactly. And other times he's like super pessimistic and he'll offer you a really low price.
So it's like he has mood swings.
Yeah, totally. And Graham said the intelligent investor, they learn to use Mr. Market's mood swings to their advantage.
Okay, interesting. So how do you do that?
Well, instead of letting Mr. Market's emotions affect you, you should see his low offers during like a downturn as a chance to buy stocks at a discount, and his high offers during like a boom as a chance to sell and make a profit.
So you're not letting Mr. Market dictate your own emotions.
Exactly. You're not trying to guess what he's going to do next. You're just reacting to what he's offering you.
So the key is not to try and time the market, but to be ready to take advantage of the opportunities that it presents.
Exactly. Graham was totally against trying to predict the market in the short term. Like he said, that's a fool's game.
Yeah, it's really hard to predict what the market will do in the short term.
He said you should focus on the long-term dividends and how well the companies you own are actually doing, rather than checking stock prices every 5 minutes.
So it's about looking at the fundamentals of the companies and not getting distracted by the day-to-day noise of the market.
Yeah, and he also talked about how people feel the pain of losing money way more intensely than they feel the joy of making the same amount of money.
That's true. Losses definitely hurt more than gains feel good.
And they can make people sell their stocks when the market goes down, even though that might not be the best thing to do in the long run.
Right, because you might miss out on the rebound.
Exactly. He even suggested that you should look at market changes as percentages instead of just points,
Okay, why is that?
so that you can keep things in perspective and not freak out over small changes. Like a 500-point drop in the Dow sounds scary, right?
Yeah, that's a big number.
But as a percentage of the total index value, it might not actually be that big of a deal.
So it's all about keeping a cool head and not overreacting to short-term fluctuations.
Exactly. Now, what about investing in funds? Like mutual funds are a really popular way for people to invest in the market these days.
Yeah, mutual funds and ETFs. It seems like everyone has them in their portfolio.
Totally. So Graham had some interesting thoughts about these. He was pretty critical of them, especially in his earlier writings.
Really? Why is that?
Well, his research showed that on average, these funds didn't actually do better than the overall market once you factored in all the fees and expenses.
So the fees were eating into the returns.
Yeah. He said that the more fees a fund charged, the lower the returns were for the investors. And he also said that if a fund was trading a lot, That would also hurt their returns because of all the commissions and taxes they had to pay.
So it's important to be mindful of the costs associated with funds.
Totally. Now, the commentary does mention that since Grant's time, there's been a big increase in no-load funds and ETFs, which don't have those upfront sales charges.
Right, those have become much more popular.
Yeah. And it's interesting because Warren Buffett, who was like Graham's star student, he actually became a big fan of low-cost index funds. Yeah. He said that most investors should just put their money in those because they're cheap and they give you a lot of diversification.
Interesting.
But Graham was still a little wary of funds that only invest in one specific sector or industry
Sector funds, why was that?
because he felt that their prices tend to jump around more than the overall market. So there's more risk involved.
That makes sense. It's like putting all your eggs in one basket.
Exactly. So when it comes to funds, the key is to keep your costs low. Make sure you're spreading your money around and maybe lean towards funds that track the whole market rather than just one industry.
So basically low cost, diversified, and broad market approach.
Yeah, that's the Graham approach to funds in a nutshell. Now, what about getting advice from financial advisors?
Yeah, that's something a lot of people rely on.
Totally. So Graham actually dedicated a whole chapter in his book to this. He said that it's really important to use common sense and critical thinking when you're getting advice from anyone about your investments.
But don't just blindly follow someone's recommendations.
Yeah, he said that you need to watch out for conflicts of interest, especially with brokers who make money every time you buy or sell something.
Because their incentives might not be aligned with yours.
Exactly. Like they might encourage you to trade more often than you really need to.
Just so they can make more commissions.
Yeah, exactly. He said that it's super important to really check out a financial advisor before you trust them with your money.
What's the best way to do that?
Well, the commentary suggests that you should look at their Form ADV. It's a document that all financial advisors have to file with the SEC. And it tells you about their background, their fees, and any potential conflicts of interest they might have.
So it's kind of like a background check for financial advisors.
Exactly. And Graham also warned people about advisors who promise really high returns. He said if someone's telling you they can consistently get you more than like 8–10% per year, you should be really skeptical.
Yeah, that sounds too good to be true.
Exactly. In the end, Graham believed that investors need to have at least a basic understanding of what they're investing in and not just blindly follow what some advisor tells them to do.
So even if you're working with a financial advisor, you still need to do your own homework.
Absolutely. Now, for someone who's not like a professional financial analyst, all this talk about security analysis can sound really intimidating.
Yeah, like you need a finance degree to understand any of it.
Totally. So what did Graham think about this for the average investor?
Well, he actually said that it depends on what kind of investor you are.
Okay.
If you're a defensive investor, you don't really need to do this like super in-depth analysis of individual companies. You should just focus on buying those high-quality companies we talked about before and make sure you're not paying too much for them.
Okay. But for enterprising investors who want to pick their own stocks.
Yeah, for them, he laid out some key things to look at, like how much money the company has made in the past, how much debt they have, and the value of their assets.
But he wasn't saying everyone needs to become like an accounting expert, right?
No, not at all. He actually said that you shouldn't put too much faith in forecasts about future earnings, even if those forecasts come from experts.
Because predicting the future is hard.
Exactly. It's super uncertain. He even came up with this idea of a past performance value as a better way to start analyzing a company.
Okay. What was that?
He basically said you should look at a company's track record of earnings and dividends to get a better sense of what it's really worth. The commentary emphasizes this point too, saying intelligent investors make their decisions based on facts and reasonable expectations, not on wild guesses about the future.
So looking at what a company has actually done in the past is a more solid way to judge it than trying to guess what it might do in the future.
Exactly. The past gives you some hard data to work with.
Right. And Graham also had a whole section about earnings per share, which is like one of the most common ways to measure a company's performance. What were some of the things he wanted investors to watch out for there?
Well, he pointed out that the earnings per share numbers that companies report aren't always the whole story. Sometimes they can be misleading because of the way companies do their accounting.
Okay.
He specifically talked about how stock options that companies give to their executives and special charges that they report can mess with the earnings per share numbers.
So those things can make the company's earnings look better or worse than they really are.
Exactly. He noticed that there were often a lot of these special charges reported at certain times of the year, and that made him wonder if they were really just one-time things or if they were signs of deeper problems at the company.
So the earnings number that gets reported in the news might not always be the most accurate picture.
Exactly. He said that intelligent investors need to dig deeper into the financial statements and read the footnotes to really understand what's going on.
So don't just take the numbers at face value.
Right. You have to do some digging to get the full story. The commentary actually gives some examples of costs that companies labeled as non-recurring, but that kept popping up over and over again.
So that's a good reminder to be skeptical and do your homework.
Absolutely. Always be critical of the information you're given. So, to bring it back to stock selection, what did Graham recommend that defensive investors should actually look for in a company?
Okay, so for the defensive investor, Graham said the most important thing is to build a portfolio that's diversified. Like, don't put all your eggs in one basket. He said to focus on companies that are large and financially strong with a long track record of success. And he specifically liked companies that had a history of consistently paying dividends.
Okay, solid companies that share their profits with investors.
Exactly. But he also stressed that you shouldn't pay too much for these companies, even if they're great companies. The price you pay is really important.
Yeah, overpaying can wipe out your margin of safety pretty quickly. Did he have any specific benchmarks for financial strength?
Yeah, he actually did. He said that for industrial companies, the value of their common stock equity should be at least half of their total capitalization, which includes all their debt.
So they should have more equity than debt.
Yeah, basically. He wanted to make sure that companies had a strong financial foundation. For utilities, he suggested a lower threshold, like 30%, because they're generally considered to be more stable and less risky.
Makes sense. So those were the guidelines for defensive investors. What about for the more active enterprising investors? What kind of strategies did Graham talk about for them?
Well, he talked about a few different approaches. One was buying stocks that were trading for less than their net current asset value, which is basically the value of their most liquid assets, like cash minus all their liabilities.
So you're basically buying $1 for 50 cents.
Yeah, kind of. He gave the example of Cone Mills in 1970, where the stock price was way lower than the company's net current asset value.
Interesting.
He also talked about bargain situations that could happen when one company tries to buy another company, like when National Biscuit tried to buy Aurora Plastics. There was a brief opportunity to make money because of the price difference between the two stocks.
Oh, I see.
And he even mentioned that you could make money from company liquidations, which is when a company sells all its assets and gives the money back to the shareholders.
So there are different ways for enterprising investors to find undervalued companies.
Yeah, and he used Universal Mary & Co. as an example of that.
Got it.
But he did warn that these more adventurous strategies should only be a small part of an enterprising investor's portfolio.
So don't go all in on risky bets.
Exactly. And he said that enterprising investors should regularly look at lists of stocks that are at their 52-week lows, because those stocks might be undervalued and overlooked by the market.
Okay, so that's a more accessible place to start looking for potential bargains.
Yeah. We've covered a lot of ground here. We've talked about the basic principles, the different types of investors, how to think about the market, and specific ways to choose stocks. So what are the main takeaways? What are the practical lessons and mindset shifts that someone should get from all this?
Okay, so let's break down the key takeaways. First, you really need to understand the difference between investing and speculation.
Really get that into your head.
Yeah, it's fundamental. And always look for that margin of safety in every investment you make. It's your protection against the unexpected.
Right.
And you need to honestly figure out if you're more of a defensive investor or an enterprising investor, and then stick to a strategy that fits your personality and your time commitment.
Right.
And don't be afraid of the market going up and down. See those changes as opportunities to buy low and sell high.
Yeah, use Mr. Market's mood swings to your advantage.
Exactly. And be really careful about high fees and trading too much inside of those investment funds. It can really eat into your returns.
Yeah, those costs can add up.
And always do your own research on financial advisors before you trust them with your money. Don't just take their word for it.
Due diligence is key.
Absolutely. And understand that the earnings numbers that companies report aren't always the whole story.
Yeah, dig a little deeper.
Right. And for those defensive investors out there, stick to high-quality, diversified companies that you buy at a reasonable price. And for the enterprising investors, be ready to really research those potentially undervalued companies, but don't forget to spread your risk around.
Diversify, diversify, diversify.
Exactly. Now, all of that is super important, but the mindset shifts might be even more important for long-term success.
Okay, so what are some of those mindset shifts?
Well, first of all, you need to be patient. Investing is a marathon, not a sprint. You need discipline to stick to your plan, and you need to be a lifelong learner.
Always be learning.
The market is constantly changing. You need to keep up. You also need to control your emotions. Don't make rash decisions based on fear or greed. And you need to think for yourself. Don't just follow the crowd.
Be independent.
Exactly. Don't get caught up in the hype. Focus on building real value over the long term. And remember that, as Graham said, the investor's biggest enemy is often themselves. So you need to be aware of your own biases and how they can affect your decisions.
So it's like a mental game as much as a financial game.
Totally. You have to be mentally prepared to succeed in investing.
Okay, so based on all of this, what are some concrete things that someone listening can do right now to start applying these principles?
All right, so first things first, figure out what you're actually trying to achieve with your investments. What are your financial goals? And be honest with yourself about how much risk you're comfortable taking.
Set your goals and know your risk tolerance.
Exactly. Then come up with a long-term plan for how you're going to invest your money. That plan should include how much you'll put in stocks versus bonds, and that should be based on your goals and your risk tolerance.
Makes sense.
Now, if you're a defensive investor, think about putting your money in low-cost, broadly diversified index funds, or carefully choosing some good dividend-paying stocks that fit Graham's criteria.
Okay.
And if you're more of an enterprising investor, set aside some regular time to research companies that might be undervalued. Use Graham's principles to guide you, but remember to diversify. And don't put too much money into any one company.
Spread the risk.
Exactly. And make it a habit to review your portfolio regularly and rebalance it if you need to, so that you stay on track with your long-term plan. And, maybe most importantly, don't believe everything you hear about those hot investment trends. Be skeptical. Something sounds too good to be true. It probably is.
A healthy dose of skepticism.
Absolutely. Don't get caught up in the hype.
So who do you think benefits the most from reading The Intelligent Investor?
You know what's amazing about this book is that it's truly timeless. It's valuable for people who are just starting out with investing and want a solid foundation to build on. And it's also great for experienced investors who want to remind themselves of the basics and avoid making common mistakes.
So it's for everyone.
Yeah, pretty much. Anyone who wants to be successful with their investments over the long term. Anyone who wants to build wealth in a smart and disciplined way.
So if I had to summarize the big takeaway from Benjamin Graham's The Intelligent Investor, it would be this. Focus on the real value of a company. Protect your money. Make rational decisions. And ignore all the noise and distractions in the market.
That's a great summary. It's about being smart, being patient, and not getting swept up in the emotions of the market.
Yeah, and I think one final thought for our listeners to think about is this.
Yeah.
How can you apply this idea of a margin of safety to other areas of your life? Not just investing. It's like a really powerful concept that can help you make better decisions in all sorts of situations.
That's a great point. It's about thinking ahead, anticipating potential problems, and building in some buffer to protect yourself.
Exactly. It's like a life hack for making smarter decisions. Don't forget to subscribe to our podcast and share our YouTube channel with anyone who might find this deep dive helpful.
And thanks for listening to Beyond the Pages. We'll see you next time.